If you're investing internationally, it's essential to understand not only the financial underpinnings of a country, but the political landscape as well. In his new book, The End of the Free Market, Ian Bremmer tackles a big picture topic that reverberates in every portfolio: the advent of state capitalism in many of the countries where investors are seeking opportunities. Bremmer is president of Eurasia Group, a leading global political risk research and consulting firm. Welcome, Ian. Wow, that's quite a title you got.
It's
there.
A mouthful. I apologize, Joe.
That's quite all right. So let's dive into it. What is state capitalism?
Well, state capitalism is a system where the state is the principal actor in the economy. You know, over the last 40 years, it's been almost an unspoken truth that multinational corporations are becoming the dominant actors. They're taking over. You look at those movies, Network or RoboCop or Rollerball, those are the dystopias that we focused on. The corporation was taking over. Today it feels almost quaint. And in the last 2 years of the global crisis, the one thing that's very clear is the state is back.
And where do you see that predominantly? In which countries where can we see the best examples of the state really leading the way?
Interestingly, it's happening in countries that are authoritarian, and the state is really in charge without rule of law, and where there are different types of natural resources that they can exploit: commodities, oil and gas, labor. So Saudi Arabia and the states of the Persian Gulf, Russia, and most importantly and fastest growing out of this global recession, the world's now second largest economy, China.
What does this mean in terms of when you are investing? What do you need to know about state capitalism and how it operates?
Well, the first thing you need to understand is that state capitalism is not interested in having global access to capital or labor or consumer markets. It's interested in promoting the interests of the state, which means that global markets are going to fragment, they're going to get smaller. That means that global growth is going to decrease. Secondly, it means we'll see more regionalization and domestic nature of capital flows and trade flows. But third, it means we're going to see lots of fights between states and corporations. And when corporations are fighting against states that are state capitalist, they will lose.
So what happens if I'm investing in China and I hear about state capitalism? Here we have the greatest example of exploiting labor, and we just found out that China is the biggest consumer of energy now.
Yes.
What do I need to know? Should I not be investing in China? Should I be investing in U.S. companies doing business in China? What's the better way for me to go?
Indeed, the problem is that Western companies investing in China, unless they're indispensable long-term to the Chinese government, are likely to get hurt, which is why you have corporate CEOs, Microsoft, GE, that are now saying, we don't think we can work in China long term. It's not our future. They never would have said that years ago. So Western corporations investing in China with large exposures are increasingly dangerous. The Chinese market itself, though they've taken a big hit this year because the run-up had been so strong, we definitely still believe in Chinese growth. There isn't a huge real estate bubble, only in a few cities in the high end. We believe in Chinese real estate. Infrastructure, those are areas that will do very, very well, but the Western firms may not be taking advantage of it.
Give me a few examples of a Western firm that is making it there.
Sure, I would look at the big consulting firms. I'd look at firms in healthcare. I'd look at firms in alternative energy. These are areas where the Chinese economy does not have its own state champions, doesn't have its own private companies that are doing very well, and they're not close to developing them. Yet the Chinese government desperately needs these sectors if they're going to start to move away from dirty coal to provide electricity, or they're starting to provide their people with a safety net that will allow them to start spending. Domestic consumption needs to start fueling Chinese growth, as the Americans and Europeans can no longer afford to buy their exports.
And I understand from some folks who are doing business over there that there's a little bit of a wink and a nod, maybe even a pinky swear, that is between the Chinese and the American companies. Whereas the Chinese say, we'll let you in, you can make money for a certain period of time until we figure out how to do what you're doing, and then you're going to get booted out. Do you agree with that?
Well, I think that the Chinese sort of have that agreement, and the Americans are standing around without pinkies. And I think that's a real problem, you know. Americans do this stuff short term, right? Goldman Sachs, BP, what do they have in common? Short-term maximization of compensation and shareholder return, and long-term, we don't care what the risks are, right? American corporations putting technology in China are doing the same thing. It's the latest manifestation. They're making a lot of money short term because they're going to sell 1.3 billion pairs of sneakers. And then suddenly the Chinese have the technology. And where was that American CEO that made that deal? Oh, he's made a lot of money, but he's gone. You're left holding the bag. That is a very real concern. And frankly, you know, the United States, we don't have great regulatory policy. We don't have great industrial policy. There's not much the government's doing on this side either.
So I can't let you go without talking about the recently passed financial reform and some of your thoughts about that, whether it will prevent the next crisis or not, and what you think it does or doesn't do well.
Look, it'll prevent the last crisis. And we're always good at that. You know? I mean, I'm sure that what we'll do on the oil reg side will present another exact replica of BP. And I do think that this regulation is going to make it a little more difficult in terms of capital requirements for the biggest institutions. It's probably going to benefit the independent securities firms. This is not the end. We still have investigations that are coming out of Congress as to what happened, who's to blame for the financial sector. I'd like to see something done about the real problems and conflict of interest in the ratings agencies. That's not being addressed effectively right now. I think consumer protections are moving in the right direction. Look, on balance, it's a good bill. But is it going to resolve the issues that we have that are deep-seated? No, this is going to take years, and we should expect that. And I think the banks do expect it.
What's the top 3 things that an investor should think about right now if he's looking at his portfolio? Where are the places that he or she should be investing, and where are the places that he or she should avoid?
Well, I would say, first of all, some of the hedging plays by multinationals that are having problems in China are going to be very attractive. So that means India, which has been slow because of infrastructure development, for example, and Indonesia, both of which are looking more attractive just domestically, but are going to see a big influx of cash coming because of the hedging away from China. Number 2, I'm still very, very skeptical about the euro. I'm very skeptical, not that it holds together, but that it's going to take years for these guys with massive fiscal austerity to get through the depths of this crisis, and they're going to do it in the absence of effective institutional governance, which means there are plenty of reasons that institutional investors will find to be defensive about European economies, and you don't want to see the man on the street get whacked by that. But number 3, let's believe in the dollar, because in the absence of the euro and the absence of the yen doing well, there is no other reserve currency. The Chinese now have over $900 billion of their reserves invested in treasuries. And when I was testifying on the Hill a few weeks ago, they asked me if I was worried that we had a problem because of that we owe the Chinese $900 billion. No, I don't think we have a problem. I think they have a problem when we owe them $900 billion because they need us to succeed. And they can't go anywhere else. So over the short to medium term, the dollar is still strong. It's the largest economy out there. More money is being spent on research and development than anywhere else. The demographics are strong. Long term, of course, we've got serious issues. Right now, though, we should still focus on the dollar.
Okay, serious issues for the next book.
Serious issues for the next book.
All right.
For this book, let's go dollar.
Okay, so cheerleader of the greenback, Ian Bremmer, thank you so much for joining us.
My pleasure, Joe.
And thanks for watching.